What is shorting a stock, and should you short a stock as a beginner trader? Stick around and we'll jump into it. Welcome back to the Framework Fortune YouTube channel. I am your host, Ben, and today we are going to talk about shorting stocks, what that means, and should you try to short stocks as a beginner trader. Okay, if you find this video helpful and you're new to trading, hit that like button and subscribe and give that notification bell a little poke to receive updates of when new videos come out. I put out videos weekly, guys. Okay, so let's go ahead and dive into it. Shorting stocks. Basically, what that means is you're going to bet against a company. Okay, you think that a certain stock is going to crash instead of go on a big rip, and you can make money off of that. But you can also lose a lot of money off of that. Okay, guys? Shorting can be very profitable, but it can be very dangerous. It goes back to like I've said on other videos, to short you need a margin account. And if you're a new trader, you probably shouldn't be on a margin account, because a margin account is where your broker loans you money on top of your money, and if you lose that money, you're going to have to pay that broker that money back. So it's a lot riskier if you don't know what you're doing. Now, the way you short a stock is you hit the sell button on your platform, or short button, depending on what platform you use. I use Thinkorswim, so you just hit sell. But what it does is you tell that broker that you're using, like TD Ameritrade or E-Trade, whoever your broker is, you tell them, I'm going to sell, say, 1,000 shares of this stock. And that broker or whatever your broker is, they have pools of stocks. So if they've got 1,000 shares of that stock available, they will let you sell it at that price. Say you want to sell it at $1.50 a share, 1,000 shares, because you think it's going to hit $1.50 and then crash. So you sell it at $1.50, okay, and you have to buy those shares back to give back to that broker, right? Because you sold their shares, so you have to buy them back to give them back to them. So it hits $1.50, it starts crashing, so it crashes back down to $1, and you buy those 1,000 shares back for the broker at $1. So the broker's not out anything. They got their 1,000 shares back. They're fine. Now the difference in that price is the money you make or lose. So like I said, if you short the stock at $1.50, you sell 1,000 shares of it at $1.50, then you buy them back at $1, they get their 1,000 shares, and you get that difference, that little price difference, that 50 cents. So on $1,000, that would be $500, right? Now, if it goes the other way, say you short it at $1.50, you sell those 1,000 shares from the broker, and it goes up to $2, you have to buy those shares back. So you've got to buy them back at $2 a share, which means there's a $500 difference there that you have to make up, right? Because the other way, you made a nice little profit, but when the price goes up and you're betting against it, that $500 you're going to owe TD Ameritrade, right? Because you bought their shares back at a lot higher price. So there wasn't any profit to be made. But it can be a lot more dangerous than just betting a stock is going to go up, because a stock can only go to zero. If you buy 1,000 shares of a stock at $1.50, it can only go to zero. There's no stocks that go below $0. There's no negative price stocks. There can be 0.000019 price stocks, but that's still higher than $0. So you can't lose any more money than zero at the bottom, right? I mean, you can lose a whole $1.50 a share, but you're not going to lose any more than that. Where with shorting, because you're betting that the stock is not going to go up, so when you take a loss is when the stock keeps going up. Well, it may stop at $2. Say if you got in $1.50 on the short, but what if it doesn't? There's no number that stops when numbers go up. That stock could go up to $100. It could go up to $1,000. It could go up to $100,000. It can go up to $1 million. So you can infinitely lose on shorting, whereas going long, you can only lose down to zero. You should not short stocks as a beginning trader because you can lose your account. Yes, you can blow an account up, but because you're on that margin and there's no ceiling to how high a stock can actually go, you can also ruin your life, okay? Because if you lose, if that stock goes from $1.50 to $150,000, you've got to make that difference. You have to pay that difference. And if you don't have $150 or $149,999 sitting around, then that's gonna ruin your life. You're gonna owe that broker a ton of money. Okay, so it's not a good idea as a beginner trader to short. Okay, like I said, you're betting that the stock is going to crash, and if it doesn't crash and it just keeps going up and up, well, you placed the wrong bet, and it can be like gambling where you hear people bet their whole entire house on a poker hand and then they lose it. That's the same thing with shorting. Going long when day trading or swing trading, you can lose some money, but you're not going to lose your house. You're not betting everything you have potentially like you are with shorting. So that's why I'm against it, especially as a new trader. It can be profitable, but like I said, you shouldn't be on a margin account as a new trader anyway, which you need to short. So think about that before you decide to short. I'm sure you'll see some gurus out there who say the best way to make money is shorting because stocks are always crashing. They're always going up real big and then they'll drop real fast and you can make money there. And you can, but you got to really know what you're doing and have some really tight stop losses so you don't get in a bad predicament. Okay, guys? So that's pretty much it for what it means and how to short and why you probably shouldn't short as a beginning trader. There's plenty of shorting strategies out there. I'll just go over a few simple ones, but like I said, I still wouldn't try this with real money. If you're a new trader, maybe try it paper trading and master at paper trading if you like to short. And then once you're comfortable as a trader, probably after 2 or 3 years, you could probably incorporate shorting into your strategies. But a real simple way to short is a bad press release. Say a medical company, a pharmaceutical company, they've been doing really good in their phase 1, 2, and 3 testings, and they come out and say that they were declined FDA approval for their drug. What do you think is probably going to happen? If they're declined that FDA approval that they've been working so hard that their investors have been staying invested in, it's going to probably crash pretty hard. And the same thing can happen with bad earnings. You see stocks during earnings season come out with bad earnings, you see them crash right away. Now they can bounce back. That's another one of my favorite patterns, the dead cat bounce during earnings seasons. But you can make some good money shorting there. So pretty much anything like that, bad earnings, bad press releases, no FDA approval. If a company says they're going out of business, their price is probably going to crash pretty hard. A lot of times public offerings will make stocks crash. So there is a lot of ways to make money in shorting. It is true. But like I said, it's something you want to practice quite a bit with paper trading way before you ever try to short, guys. Okay? Just practice it if it's something you want to learn. It's not that difficult to do, but it does have a very high upside of risk. So just keep that in mind. Alright guys, that's it for this video today. I will probably do some more videos on shorting later. Maybe even dive into the platform and show you how to do it. But if you like what you saw today, hit that like button and subscribe. Just flick that notification bell. Until next time.